Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
All right, we've got three major stories for you today. We're starting with the high-stakes battle heating up at the Federal Reserve. Governor Lisa Cook is facing a criminal probe, President Trump is threatening her job, and prediction markets like Kalshi are going wild. Then we'll shift to a different kind of conflict, one fueled by a $25 trillion real estate transfer between generations. We'll look at why BMY Wealth says family fights are inevitable and how some are turning to prop tech and even blockchain for a solution. And finally, we'll unpack the historic 41.7% stock plunge at WH Smith. It's a story about a £30 million accounting blunder that one analyst is calling an absolute disaster. A sitting Federal Reserve governor is now the subject of a criminal investigation. Fed Governor Lisa Cook is facing accusations of mortgage fraud, and the Justice Department has confirmed an investigation will take place. But in a direct statement of defiance, Cook fired back, saying she has, quote, no intention of being bullied to step down from my position. So the thing is, this situation fits a modern playbook for attacking the credibility of officials in independent institutions. The World Economic Forum has highlighted how these campaigns often use fringe legal claims, amplified by social media, to erode public trust. You know, the goal isn't always a conviction. Sometimes it's about creating enough noise and doubt to damage an institution's reputation, and the pressure is escalating at an incredible speed. US President Donald Trump has publicly called for her resignation and now threatens to fire her if she doesn't leave. The threat to fire a Fed governor isn't as simple as it sounds, and this is where it gets tricky. The Federal Reserve Act states a president can only remove a governor for cause. What's crucial to understand is that the term for cause has never actually been legally defined or tested in court. It's completely uncharted territory. An attempt to remove a governor would likely ignite a massive legal and constitutional battle, sending shockwaves of uncertainty through the global economy. The markets are definitely taking notice. On the prediction market, Kalshi, the odds that Governor Cook will be out this year spiked from just 21% to over 30% in a single day following those comments. This is where the situation takes a more complex turn. Prediction markets like Kalshi are no longer just passive forecasting tools. By allowing people to trade on political outcomes, they are becoming active participants that can amplify political pressure. A headline-grabbing threat is made, the market reacts, which in turn creates another headline. It's a feedback loop that can influence the very outcomes they're supposed to be predicting. Believe it or not, this isn't just about one governor. It's part of a much larger high-stakes battle. Current and former Fed officials are now publicly defending the central bank's independence. Cleveland Fed President Beth Hammack called Cook a person of high integrity and stressed the critical need for the Fed to maintain its autonomy. This all comes as Trump ramps up his criticism of Fed Chair Jerome Powell, who he has nicknamed too late and accused of being political. The president has even threatened to allow a major lawsuit against Powell to proceed. The Federal Reserve has always operated as an independent entity, walled off from political pressure, but with a criminal probe, a direct threat of firing, and a war of words. That wall is showing cracks. It leaves us wondering, is the long-standing independence of the world's most powerful central bank now officially in play? We don't have to guess. We have recent alarming examples. In Turkey, political interference in the central bank led to the lira losing 44% of its value in a single year. In Argentina, the central bank was pressured to finance government spending, triggering hyperinflation where prices soared over 3,000%. The stakes are incredibly high because when a central bank loses its independence, investor confidence evaporates and inflation can spiral out of control with terrifying speed. From the high-stakes battles at the Federal Reserve, we're now turning to conflicts brewing much closer to home, involving a staggering $25 trillion tidal wave of real estate about to be passed down to the next generation. But that cherished family beach house, it's often a ticking time bomb for conflict. One senior wealth strategist at BMY Wealth puts it bluntly, I can tell you as a practical matter, there's going to be fights. You're not going to have the perfect situation. The first battleground is taxes. What's crucial to understand is the concept of a stepped up cost basis. If you inherit a property after death, its value for tax purposes is reset to the current market value, meaning little to no capital gains tax if you sell right away. But if it's gifted to you before death, you inherit the original much lower purchase price. Selling it then could trigger a massive tax bill. It's a huge difference. The complexity doesn't stop there. The ultra wealthy are now placing homes inside LLCs and trusts to shield them from creditors and even a child's future ex-spouse. As one fiduciary officer from Northern Trust says, the goal is often to retain these properties along the bloodline. Interestingly enough, the most common trigger for family feuds is simply money for upkeep. One strategist warns that when a single sibling is left paying the bills, enormous resentment grows. To avoid this, families are endowing these properties with cash funds or entire life insurance policies just to cover future costs. So, to tackle these logistical nightmares of scheduling and paying bills, a whole new industry of property technology or prop tech is emerging. There are now apps designed to be a neutral operating system for the family property. Companies like Plum Connect and CoBuy offer tools to manage shared calendars, split expenses, and even facilitate votes on big decisions. A fascinating attempt to use technology to mediate very human conflicts. However, if you zoom out, you'll see another layer of strategy at play. After all that complex planning, some heirs may just want to cash out. Even these buyouts are complicated, but here's where some experts believe blockchain technology could revolutionize everything. Imagine the family home as a set of digital tokens. If one heir wants out, they can sell their tokens to the others in a secure, transparent transaction. It's a radical idea that could make painful buyouts much smoother. Ultimately, this situation presents a fascinating duality for anyone leaving a legacy. On one side, there's the desire to preserve a family sanctuary. On the other, in what some call the VRBOization of legacy homes, these properties become commercial assets, weakening emotional ties and making that decision to just cash out even more likely. Speaking of technology's role in finance, it's not always the solution. In fact, sometimes it can't prevent a very human and very costly mistake. That brings us to WH Smith, whose shares just plunged 41.7%, putting the company on track for its worst single-day decline on record. The reason? A massive accounting blunder that analysts are calling a huge embarrassment. The error was in something called supplier income. Now get this isn't money from customers. It's revenue from complex deals with suppliers, like rebates or fees for premium shelf space. The company essentially booked this income prematurely, making its profits look much healthier than they were. Getting the timing wrong by £30 million is a fundamental mistake. As a result, the company has been forced to slash its profit forecast for its crucial North America division by more than half, from an expected £55 million down to just £25 million. One analyst at AJ Bell called the incident nothing short of a disaster, adding that investors will be sobbing into their cornflakes. Susanna Streeter at Hargreaves Lansdowne said shareholders are reeling, noting that getting it so wrong is not a good look and affects the reputation of the company. But that's not the whole picture. The real turning point is that this error strikes at the very heart of WH Smith's new identity. The company recently sold its iconic UK high street division to bet everything on becoming a global travel retailer with North America as its main engine for growth. Now, that travel strategy is more sophisticated than you might think. It's not just about high prices. These airport stores use tech to analyze passenger flow and even dynamic pricing algorithms that can adjust costs based on flight schedules. This is the high-margin, data-driven future WH Smith was betting on. That fresh start is now severely tarnished. The blunder has cast a massive shadow over its entire strategic pivot, prompting an independent review from Deloitte. So you have to wonder, how does an error this huge get missed? Well, it actually tells us something crucial about the limits of technology in auditing. We hear a lot about AI, but research from the UK's Financial Reporting Council found that the biggest firms aren't formally tracking how effective their AI tools are at improving audit quality. This means complex revenue errors can still slip through, requiring human experts to come in after the damage is done. This leaves one final question. Is this a contained mistake, or, as one analyst fears, is this just the loose thread that could signal bigger problems? When a stock drops over 40% in a day, it's a stark reminder of how modern markets work. A huge part of that drop is likely driven by high-frequency trading algorithms programmed to sell on keywords like accounting error, amplifying the crash far beyond any initial human panic.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.